Welcome to Finance Insider. We're going to break down some complex financial topics today, and hopefully you can make sense of it all. I'm Big Joe.
Hi, I'm Mary.
All right, Mary. So today we're going to dive into the world of Forex trading.
Sounds good.
Specifically, we're focusing on spotting market trends, and our listeners sent us an article from BabyPips.com. Seems like a great place to start.
Absolutely. It's a fantastic resource for Forex traders of all levels. But before we jump into the specifics of the tools, maybe we should talk about what trends actually are.
Yeah, good idea. What exactly are we looking for when we're talking about trends in Forex?
Essentially, a trend is just a sustained movement in price. Like, imagine a river flowing in a particular direction. That's kind of what a trend looks like on a price chart.
Makes sense, but like rivers don't always flow in a straight line, right?
Yeah.
What about those times when the price kind of jumps around? Like, does that mean there's no trend?
Well, those little jumps and wiggles, those are called retracements. They're like temporary price fluctuations that go against the overall trend. Think of them like little eddies in the river.
Okay, so it's more about like the big picture direction, even if there's some noise along the way.
Exactly. And to help us see that big picture, we need to look for certain patterns on the chart, right? The article talks about higher highs and higher lows for an uptrend.
Yeah, and the opposite for a downtrend, right? Lower highs and lower lows. But can you break that down a bit more? What exactly do those terms mean?
Sure. Imagine you're climbing a staircase. Each step you take higher, that's a higher high. And those little dips before you take the next step, those are your higher lows.
Okay, so it's like a visual pattern we're looking for.
Yeah. And if you flip that staircase upside down, that's what a downtrend looks like, with lower highs and lower lows. So recognizing those patterns is a good starting point, but we can also use some technical tools to help us see trends more clearly.
That makes sense. So it's not just about eyeballing it. We've got some gadgets to help us out.
Yeah, exactly. And the article mentions 3 specific tools: the ADX, moving averages, and Bollinger Bands.
3 tools. Wow, it's like having a whole toolbox to work with.
Right. Each tool gives us a slightly different perspective on the market, so using them together can be really powerful. Kind of like, 2 heads are better than 1.
Absolutely. Let's start with the ADX. The article describes it as a strength meter for trends, which sounds pretty cool, but what exactly does that mean?
It means it tells us how strong the trend is. Think of the ADX as a scale from 0 to 100. Any reading above 25 suggests a strong trend, and the higher the reading, the stronger the trend.
So if the ADX is like pumped up, it's basically shouting, hey, pay attention, there's a powerful trend happening.
Exactly. But here's the catch then. The ADX doesn't tell us which way the trend is moving. It just tells us that there is a trend, whether it's up or down.
Okay. So it's like a speedometer. It tells us how fast the car is going, but it doesn't tell us if we're heading north or south. We need to look at something else to figure out the direction.
Yes, that's where analyzing price action, like those higher highs and lower lows, or using other indicators becomes important.
Got it. So ADX is our trusty sidekick, confirming the strength of the trend. But we're the detectives who need to figure out the direction. Now, what about those mysterious moving averages? I always hear traders talking about those. The article suggests using periods of 7, 20, and 65. What's the magic behind those numbers?
Think of a moving average as a line on the chart that smooths out the daily ups and downs, giving us a clearer view of the overall trend. So instead of seeing all those jagged price movements, it's like drawing a smooth line through them.
Okay, so we're kind of like filtering out the noise, right, to get a better picture of the trend. But why those specific numbers, 7, 20, and 65?
Well, those numbers represent different time frames. So the 7-day moving average shows us the average price over the past 7 days. The 20-day shows the average over 20 days, and so on.
So we've got 3 lines representing different time frames. I imagine them like a braid on the chart, kind of weaving together.
I like that analogy. And the way these lines interact with each other, that's what tells us about the trend direction. If the shorter period moving average, like the 7-day, is above the longer ones, that usually signals an uptrend.
Oh, I see. So it's like a horse race. The shortest average, that's usually the fastest one, leading the pack in an uptrend.
Exactly. And if the shorter average is below the longer ones, that could suggest a downtrend.
Got it. But I'm guessing it's not always that straightforward, right? Those lines probably cross over each other sometimes.
They do. And sometimes those crossovers can signal a potential shift in the trend. But we need to be careful and not rely solely on those crossovers. It's important to consider other factors as well.
Right, those lines might just be messing with us, making us think there's a trend when it's just a temporary blip. Okay, last but not least, we have Bollinger Bands. Now, I always thought those were for like range-bound markets where the price is kind of bouncing back and forth, but the article says they can actually help us identify trends too. How does that work?
You're right, Bollinger Bands are often used to identify range-bound markets. But that's actually the key to how they can help us spot trends too. Think about it, markets actually spend most of their time ranging. Trends, those big sustained moves we're looking for, those are more like the exception, the breakout moments that we want to catch.
Oh, that's interesting. So trends are like the exciting part, the moments when the price finally breaks free from its usual routine. And Bollinger Bands help us spot those breakouts.
Exactly. They use something called standard deviation. It basically measures how much the price typically fluctuates around its average. And Bollinger Bands plot those deviations as lines above and below a moving average. So you end up with these zones on the chart.
Okay, I think I'm starting to see the picture.
Yeah.
So we have these zones above and below the middle line, kind of like guardrails on a highway, right?
Yeah.
What happens when the price breaks through those guardrails?
That's when things get exciting. Imagine you have a buy zone above the upper band and a sell zone below the lower band, the space in between. That's like our no man's land, where the price is just doing its usual ranging thing.
Oh, so when the price breaks out of one of those zones, it's like a signal flare telling us a new trend might be starting. That's our cue to hop on board and ride that wave.
Well, not so fast. Remember, these are just tools to help us identify potential trends. They're not like crystal balls or anything. It's still important to confirm those signals with other forms of analysis, and always manage your risk.
Right, we don't want to just blindly jump into any trade just because a line crossed over another line or the price broke out of a band. Forex trading is still like navigating a jungle. We need to be prepared for anything.
Exactly. It's a wild world out there, and we need to use all the tools and knowledge we have to navigate it successfully.
Well said, Mary. So we've got these three powerful tools: ADX, moving averages, and Bollinger Bands, each with its own unique way of looking at trends. But the big question is, how do we actually use these tools to make trading decisions, like in the real world when we're looking at our charts and trying to figure out what to do next?
That's a great question, and that's exactly what we'll be diving into in part 2 of our deep dive into trends in Forex trading.
Stay tuned, folks. We'll be right back after a short break. All right, welcome back to Finance Insider. Before the break, we were talking about these three cool tools for spotting trends: ADX, moving averages, and Bollinger Bands.
Yeah, we were just getting to the good part, how to actually use these tools in our trading.
Right, like it's one thing to understand what they are, but it's another thing entirely to know how to interpret their signals and actually make trading decisions based on them.
Absolutely. So let's start with the ADX.
Okay, ADX, our strengths meter for trends. So let's say we see the ADX is above 25. Does that mean we should like automatically hit the buy or sell button?
Not so fast. Remember, the ADX doesn't tell us which way the trend is going. It just tells us how strong the trend is. Like, it's like a gauge that shows high pressure.
Right. It could be high pressure hot or high pressure cold.
Yeah.
We need to look at something else to figure out which one it is. So how do we actually use the ADX effectively?
Think of it as a confirmation tool. Let's say you see a price pattern that suggests an uptrend, like those higher highs and higher lows we talked about earlier.
Okay.
If you also see a strong ADX reading above 25, well, that would give you more confidence that the uptrend is real and likely to continue.
So it's like having a second opinion from a trusted advisor, giving you that extra reassurance before you make a move. Okay, I like that. Now, what about moving averages? How do we use those braided lines to make trading decisions?
One common way is to look for crossovers. When the shorter-term moving average crosses above the longer-term one, that's often seen as a bullish signal, suggesting the price is likely to trend upwards.
Okay, and if it crosses below?
That could signal a potential downtrend, like a bearish signal.
So it's like one of those epic crossover episodes where different storylines collide and sparks fly. But are these crossovers always reliable? Do we just blindly follow them every time?
Definitely not. Think of them more like clues, not guarantees. It's always important to consider the bigger picture, like other indicators, what's happening in the market overall, and your own risk tolerance.
Right. We don't want to just blindly jump on board every time those lines cross. They might be leading us down the wrong path. Okay, last but not least, let's talk about Bollinger Bands. How do we use those buy zones and sell zones to ride the waves of trends?
Remember how we talked about prices mostly fluctuating within a range? Well, Bollinger Bands help us see that range.
Right, those upper and lower bands, kind of like guardrails.
Exactly. And when the price breaks out of one of those bands, well, it's like a wild horse breaking free from its corral. It could signal the start of a new trend.
Oh, I see. So it's like the price is finally breaking free from its routine and ready to make a big move. And we want to be there to catch that move, right?
Yeah, right. If the price breaks above the upper Bollinger Band, that could signal a bullish breakout. A break below the lower band could mean a bearish breakout. But again, it's important to confirm these signals with other indicators in your own analysis.
Right, we don't want to just assume every breakout is going to turn into a big trend. Sometimes those horses just run back into the corral. Okay, so we've got these three awesome tools: ADX, moving averages, and Bollinger Bands. But how do we know which one is the leader in each situation? Like, do they ever disagree with each other?
That's where your own trading style and risk tolerance come in. Some traders might prefer to use the ADX as their main trend filter, while others might rely more on moving average crossovers or Bollinger Band breakouts.
So there's no one-size-fits-all approach. It's about finding what works best for you and your own trading personality. I'm starting to see how these tools can work together like a dream team, each bringing its own strengths to the table. We can use ADX to confirm trend strength, moving averages to spot potential trend shifts, and Bollinger Bands to identify those exciting breakout moments. Yeah. But before we all run off to create our own trading masterpieces, I think it's important to remember that Forex trading is not a game.
Absolutely. It's crucial to approach it with caution and with a good dose of realism. You know, Forex trading involves real money and real risks. And even with the best tools and strategies, there are no guarantees. You could lose money.
Right, and no trading tool can predict the future with a 100% accuracy. So before you dive headfirst into any trade, make sure you've done your research, understand the risks involved, and have a solid plan in place to manage your risk.
And practice. It's always a good idea to start with a demo account, to test out these tools and strategies in a risk-free environment before you start trading with real money. That way you can get comfortable with how everything works without risking any of your hard-earned cash.
Excellent advice. And remember, folks, this is just the tip of the iceberg when it comes to Forex trading. There's a whole world of knowledge out there, and we encourage you to keep exploring, keep learning, and never stop asking questions.
Absolutely. This deep dive has hopefully given you a taste of the possibilities. We've equipped you with some powerful tools to start identifying those market trends, but now it's up to you to take that knowledge and run with it.
So the question is, how will you use this knowledge to navigate the exciting world of Forex trading?
Will you be drawn to the steady guidance of the ADX, or will you be captivated by the dynamic crossovers of moving averages? Maybe you'll become a master of Bollinger Band breakouts, or maybe you'll discover your own unique combination of these tools. The possibilities are endless.
But the journey begins with taking that first step. So go out there, explore, experiment, and most importantly, never stop learning. That's what makes trading so fascinating. There's always something new to discover.
Well said.
All right, that's a wrap for this episode of Finance Insider. Thanks for joining us on this deep dive into trends in Forex trading. I hope you've gained some valuable insights today. This is Big Joe.
And Mir.
Signing off. Until next time, keep those charts burning bright, and remember, knowledge is power. We covered a lot of ground, huh? Trends, ADX, moving averages, Bollinger Bands. But before we wrap things up, I think there's something else we should mention. The article talks about liquidity.
Yeah, liquidity. That's super important, especially in Forex.
Okay, so why is that? Why is liquidity so important in Forex trading?
Well, Forex is the biggest, most liquid financial market out there. Basically, liquidity just means how easy it is to buy or sell something without, messing up the price.
So it's like if you jump into a pool, you don't want to make a huge splash and scare everyone away, right?
Exactly. In a liquid market, you can buy or sell a lot of currency without moving the price too much. Yeah. It's kind of what you want to do when you're riding a trend, right? Get in and out smoothly.
Makes sense. So how do we know which currency pairs are the most liquid? Are some more liquid than others?
Generally, the major currency pairs, especially the ones with the US dollar, those are the most liquid. They're traded all the time by tons of people, so they're always buyers and sellers.
So it's like sticking to the main highways where there's lots of traffic.
Yeah.
Instead of taking those back roads where you might get stuck. The article also talks about volatility. Is that important too?
Definitely. Volatility and liquidity often go hand in hand. Volatility is like how much of the price is jumping around. A volatile market, that can be exciting because there are more chances to make money.
But more risk too, right?
Right. It's like riding a roller coaster. Fun, but maybe a little scary.
So how do we find a good balance? Like enough liquidity to trade smoothly, but also enough volatility to catch some trends.
That's the art of Forex trading. It's about finding those currency pairs that have a good mix of both. It takes practice and, good risk management.
And every trader's different, right?
Yeah.
Some people like those wild rides. Some prefer things a little calmer. The important thing is to know yourself and what you're comfortable with.
That's a great point. I think we've given our listener a good starting point for thinking about trends, liquidity, volatility, all that. They've got some tools now to start identifying those trends and making some decisions.
Yeah. We talked about what trends are, how to use the ADX, moving averages, Bollinger Bands, all that good stuff. Hopefully our listener feels a little more confident about diving into the world of Forex trading.
And remember, learning never stops. Keep researching, testing out different strategies. The more you learn, the better you'll become.
Couldn't agree more. Well, that wraps up another episode of Finance Insider. Thanks for joining us on this deep dive into trends in Forex trading. This is Big Joe.
And Mary.
Signing off. Until next time, may your trades be profitable and your knowledge ever growing.